All right, good afternoon, everybody. Event Trader here, about to be joined by Brett Manning, Chart Trader. Brett, how are you doing today?
I'm doing pretty good, Gav. How are you?
Doing pretty good. I know we have a lot of new listeners here uh, for the first time on the Sentiment and Flow show, probably wondering exactly what it is that this show will encompass. And we didn't have a lot of creativity, I would say, Brett, in the title of this show. But just to kind of recap for people, what Brett and I are going to try to do, and Brett, obviously, feel free to jump in at any point here, is we take a look around at some of the sentiment data that's making the rounds out there and also the flow data and try to look to see if things are matching up with movements that we are seeing out in the stock market and other asset classes as well. Basically, trying to uncover, I guess we could call it arbitrage in areas where perhaps people are leaning a little too much in one direction or the other, and providing some opportunities to either get aggressively bullish or perhaps to rein in things a little bit and to tone down the risk. So, Brett, what would you like to add to that?
Yeah, no, I mean that's a reasonably comprehensive explanation. I guess really it's about identifying phase of trend and seeing phase of trend as a consequence of the degree to which you form consensus around certain ideas. Basically, the precept is, a trend moves until it's exhausted all available ammunition in that direction. When everybody's basically lined up and betting on the same thing, the market really can't go further in that direction. It's kind of a functional assumption. But as we're going to talk about today, what we have seen lately kind of flies in the face a little bit of that way of looking, a sort of contrarianist perspective, because the game theory landscape is shifting from a game that was really a sort of zero sum, I win by you losing, contained usual suspects kind of market for maybe the last decade. And really over the last few months, I think we're seeing the emergence of a non zero sum kind of productive pyramid scheme, marginal new groups coming into the market, an expanding population. We win together by the next marginal new group discovering the stock market kind of game, which is a different kind of game. And to some extent, sentiment data becomes less about trying to spot consensus contrarian opportunities and more about trying to spot where direction of trend is and when you get counter trend moves, when those counter trend moves have become extreme enough, like we saw last week, to really offer an entry point back in the direction of trend, which really doesn't necessarily mean everybody getting really bearish. It's just relative within the in the sort of set that we're building over the course of this trend, as we're seeing a huge new growth in market participants. So that's one of the things we're going to talk about here. We're also going to talk about how some of the data points that we've been following are shifting in a qualitative way because of something happening in the options market. But the show in general has been a process of trying to find extremes and imbalances in sentiment data with the assumption that sentiment data reflects where people think the market's going to go. Generally speaking, people develop those beliefs after taking positions. There's been a lot of studies about that. Psychology of market participation usually is you really know that you believe something is going to happen after you buy it. So people are really tentative. They buy something, and then afterwards they go through a process of really kind of telling themselves that they're right. And you end up getting a lot of sentiment data extremes. It really reads right through and shows positioning extremes. So the point is positioning extremes, and we use sentiment data and flow data to try to understand if we have a positioning extreme and thus the possibility that we're going to see some kind of inflection or reversal in the market.
Yeah, very eloquent, Brett. Very eloquent. So with that in mind, let's start breaking into some of this data here and taking a look at what is going on in the markets. And I guess we could start off with the sentiment side of things, Brett. In particular, we'll take a look at the Aai survey. I've got it updated this morning here, and from what I was seeing here, definitely looked like there was a little bit of a pullback on the bullish nature. I saw that drop about 3.3 basis points to 42.9% area. And then just keeping an eye, we saw bearish sentiment push up higher here at 35.5. And then the neutral really saw move towards the 27 area in the data there. So really kind of a pullback on rains on the bullish side of data that I was looking at, Brett. Do you have any thoughts on the AAII? Was it pretty much in line with what you were expecting to see?
Yeah, so I commented on, I did a chart book a couple days ago that kind of looked at the fact that things were really kind of becoming less extreme in the sentiment survey. So just so everybody knows what we're talking about, AAII is the American Association of Individual Investors Survey. They do a weekly survey. Sample size is usually somewhere between 500 and 1,000 people. Basically ask the question, is the stock market going to be higher or lower or at the same price 6 months from now? And you tend to get a good contrarian read if everybody in that survey ends up kind of lining up around, 70, 80% saying it's going to be higher. Usually you have a market that's going to have a very, very difficult time moving higher. Conversely, if you have a situation where you've got, like we did in early to mid 2016, we had weeks and weeks and weeks of 80% of people thinking it's going nowhere or lower, nobody really thinking it's going higher over and over and over again. That was a really good moment to just be aggressively buying the stock market because it read right through to the fact that there was a whole lot of people who had not yet established any kind of foothold on interest in the market because they were so pessimistic about the prospects at that time. So right now we went to a positive extreme, in other words, a dangerous extreme. After we had some of the resolution around political uncertainty, some of the vaccine news, we saw in December and in January, we got some real bullish extremes there. A lot of people kind of consensus expectations of it moving higher. That's pulled back without much of a pullback in the market, which is a constructive sign for the stock market. When you see that move to an extreme and then resolve that extreme without a major down move in the market, that's usually a good sign for the stock market.
Yeah, and we're going to continue on with the sentiment data, but like Brett was saying, the fact that they've been able to hold things up here, given some of the moves there, doesn't really suggest it suggests that people are getting more cautious, but we haven't seen any signs of selling yet, Brett, and that's been one of the common themes that I've been seeing with these pullbacks, and we'll break into the Robinhood pullback as well, but
again, a growing number of market participants, which in the last sentiment flow show, that's where we resolved, right? We said there's a lot of sentiment extremes, but it may not result in a market pullback because the one thing that we can see is it looks like we've got a widening pie, an expanding population of people interested in the stock market.
Right, and we've certainly seen that play out in the headlines, and we'll talk a little bit about that. And we'll also talk about some of the cash that's on the sidelines too, which is at the lower end of the recent range, but as Brett was saying, with an expanding pie there, perhaps the reads that we're looking at on that front might not be as clear. When we go take a look at the sentiment numbers from the Sentiment Trader website, Brett, I'm seeing a lot of figures that are going into the extreme overly optimistic side, but we're going to break into a little bit of some of these options ratios, which are really kind of the primary driver, because it really goes into the point that Brett was just making about a change in people that are sitting around and trading some of these options that are perhaps skewing the data from what we want to look at and making a little bit of a tougher read on this front. So we will break into that here. First, starting off with risk appetite, Brett. We see that certainly in the bullish extreme part here. It's up at 83, which is above the historic levels that we've seen previously for risk appetite. Now, this has been running in the more aggressive side since really early November is when we saw it broke above the threshold for what's viewed as overly optimistic, and it really points to perhaps some of these options that we've seen in play, which suggests greater leverage and therefore a little bit of a higher risk appetite.
And just so people understand, the risk appetite index is an aggregation of different risk appetite indexes, which are put out by people like Citigroup and Westpac and UBS. And what they do is they look at different markets, fixed income. Is everybody skewing toward junk bonds? In currency markets, are people really skewing away from things like, the carry trade currencies like the yen? So basically, is risk going up the ladder across a number of different asset classes as a read into how it maybe is going to impact something like let's say the equities market, because it just shows a risk appetite. So if you see a lot of people, for instance, going away from treasuries and buying junk bonds, that says something about the sort of macro psychology behind markets.
Right. Moving on next, we're going to go through three of these put call ratios, Brett, that are all showing up in the extremes. First one
Mm-hmm.
is the robo, which is basically the retail crowd, and we also have the lobo, which is the large uh, institutional traders, and they are both in the overly optimistic category for sentiment trader here, as well as obviously the option speculation index. Now, all three of these readings have been skewed a little bit because, particularly with the retail, what we've seen is that they're much more likely to buy a call than they are a put right now. I guess we could say
Or
that.
then a share. That's my point. I think one of
Yeah.
the reasons it's going wrong here is one of the reasons why we're seeing the options data, which used to be a really central part of the type of analysis that we're doing. You look at something like the put call ratio, the total CBOE put call ratio. Over the course of a long period of time, you can see periods when there's not very many puts relative to calls being bought as being a process of increasing vulnerability for the market, because you've got a lack of hedging, you've got more speculation in a derivatives index, something leveraged, and that kind of it compounds into vulnerability, which eventually gets pricked and the market falls apart. Well, if people are using options instead of shares, which seems to be happening now and increasingly so, and really started maybe about a year to a year and a half ago as a new trend in the market. If the options market is stealing market share from the share market, and we assume that of any new market participant, probably about 90% of what they're doing is to the long side, then you're talking about that 90-10 ratio that's normally in the share market coming into the options market and skewing the put-call ratio dramatically. And that means when we see something like the 50-day average of the total CBOE put-call ratio get to a 20-year low, normally we would say, this is a terrible sign for the stock market. But right now, that may not be the right read-through, because it's the options market stealing market share from the share market. And so you import the same ratio that's normally in the share market for some slice of the pie of the options market, and things skew on a structural level, and it doesn't necessarily reflect an apples-to-apples relationship with historical put-call ratios. So we've got something like the robo ratio, the retail only buy to open put-call ratio is as far as I can see, it's more or less useless right now as a read-through, because it isn't saying what it used to say. So the only way that we can understand anything as far as the signal here is to put it in historical context. And if the meaning of the options market is changing on a really fundamental level right now, because it's playing a different role in the big grand scheme of financial markets, then you don't have that apples to apples comparison. And the data really seeing that thing at 0.38 or 0.32 or whatever it is, normally that would be just a massive glaring sell signal. And I'm just not sure that it means the same thing right now, because I think people are just mobilizing options bets in a way that's different. We actually talked about this last summer. I don't know if you remember, Gavin, but
Yeah.
we talked about the possibility that you've got such an aggregation of educational materials online, helping people quickly get up to speed and understand how to use options. You have a lot of new market participants who just don't even bother with shares. And that's a unique thing. And maybe it's because it's gotten easier and easier and easier to understand how to use a more exotic instrument that has inherent advantages. And it was just tougher for people to do that in 1996 or 2005 or whatever, because there just wasn't enough resources to allow somebody to quickly feel comfortable. And it wasn't normalized in their social groups. And I think that it's just become a kind of cultural change in the markets.
Yeah, and just to give you some of the numbers behind that too, daily options trading has more than doubled since 2019, and
There you go.
a lot of that has come from platforms like Robinhood. As of this month, small buyers account for about twice as much of the options volume as the big and mid-sized players, according to Deutsche Bank.
There you
And that
go.
basically just sums up exactly what we're talking about. Now, that's also why you're more likely to see some of these extreme moves lower because you simply just don't have
Yes.
people buying the protection there. Or at least, Brett, I guess you could postulate the argument that people are buying the protection. It's just being outshadowed by the moves on the call front.
I think both of those things are true, and I think that they can both be true. And I also think that
Yeah.
the long side interest, if it's centered in the options market on smaller accounts, means it takes a relatively smaller amount of delta to start some kind of, squeeze long or short, right? Like you've got market participants who have less of a threshold for pain if they're levering up a smaller account.
Right, because if you think about it, if they're starting to get squeezed, they probably don't have the massive backdrop that some of these other brokerages have in order to kind of take the paper losses right off the bat, and therefore some forced selling in it,
Sure.
is how I look at it. So I mean, and we'll break a little bit more into the Robin Hood crowd and everything. I guess one of the things I would ask you, keeping on the options side of things, Brett, um, how do you think? Do you think these brokerage houses kind of want to slow down the use of these derivatives? Uh, and if so, how do you think that they could go about kind of dissuading people? Obviously, they could raise the threshold for an account on whether or not you're able to get an options trading license in there. I know right now it's pretty easy. You pretty much just ask, and it seems like they'll give it to anybody. But um, I would think at some point, and speaks to the whole GameStop movement from last week, that in order to manage their risk a little bit more effectively, they're going to have to take some tighter controls here.
They're going to always structure their policies for survival.
Right.
So, yeah, they will. It's going to be a process of gradual evolution toward figuring out where those lines need to be drawn and how much margin can be allowed
I was going to
for
say,
something.
is margin the low hanging fruit for being able to manage this? That's
Oh,
obviously
I
what
think
happened in
that will
last
be the
week.
lever that will be the lever that's used. Same thing with the futures market. Futures market got more popular, and we had a number of these sorts of situations, and you're going to see these brokers try to find a way to find that sort of that ground where they're allowing as many transactions as possible. They're allowing whatever their business model is to monetize the interest as much as possible without creating a great deal of risk, because they don't want to end up with a whole bunch of account holders with massive negative account balances that are never going to be repaid. And they're going to structure their policies around that risk.
All right. Now we're going to take a look at a couple of other sentiment data points here, and then we'll come back and kind of wrap up the sentiment side of things. But the advisors and investor newsletter model, the AIM, that's in extreme optimism territory as well, which kind of differentiates a little bit from the AAII, Brett. Do you think it's just because the data on this front hasn't been able to catch up? This would be from January 29th as opposed to the AAII, which would have been fresh data from this morning.
Yeah, this is an aggregation of different surveys. So this is I think probably bringing in some of the newsletter people. So you've got this difference between what the individual investor feels and thinks, and what people who are Wall Street recommendations, Wall Street strategists, newsletter writers, and all of those people who really have to be constantly voicing the right side of the market, whatever it is. They get kind of cornered into being bullish when the market's going up, whereas individual investors don't have to buy when the market is going up. So there's not as much pressure there. So I tend to yeah. I mean, obviously there's good historical data that shows constructive contrarian relationships with the AIM model. So it's useful, and it's interesting to see where it is. But I tend to think that right now in this market environment, the shift back to neutral in the AAII is probably a little bit more important.
Okay. Another one, and we'll break into this for the Bank of America data too. But mutual cash fund levels, that's showing an extreme optimism. And I know the levels that we were seeing in terms of cash on hand for Bank of America is also showing
Yep.
some signs of being at low levels. And the general read through on this is that if all the money's being put to work here, what money's left to come off the sidelines and push the markets higher? However, as you're saying, Brett, it seems like there's some more options for people to be able to get in and get an influx of cash in that perhaps is not being read in these mutual fund cash levels. So,
Well, and look, these funds are taking in expanding assets, and so what portion of their portfolio is in cash? If if we were in declining assets under management or neutral assets under management, it's more important. But it's just like the earlier point, the pie's expanding. If we're seeing more and more people decide to get involved in the stock market, now not all of them are going into a fund like this. A lot of them are just they've got their own Robinhood account, whatever. But there's still going to be some expansion in assets under management. I'm sure that it's happening, and the Wall Street marketing machine, I'm sure, is fired up on full tilt right now. So, but it is interesting to see how low these cash levels are. And so this is going to be another a theme that we have for you today, which is while this market doesn't necessarily have to top with the type of data we have, there's going to be this vulnerability. And so we're going to get these shakeouts. And low cash levels are one of those reasons. You've got to, under certain circumstances, when you suddenly find out that, Maple Lane in Melbourne could blow up tomorrow, and you've got $20 billion worth of hedge fund liquidation coming, you're gonna raise cash. So there's going to be this crowding and this leveraging phenomenon. There's going to be a constant risk, and we're going to get different catalysts to come along and force some kind of shakeout and rebalancing.
Yeah, and then finally, the only other one that we had an extreme, and I was a little bit surprised at this because this is a measure of breadth in terms of the recovery, but the NYSE high-low ratio. Now, this was a common metric that we would see in 2019 and 2020 falling in under this category because, as everybody's well aware, we had the big runs going on with the FANG names being the primary driver, and there was only a couple of names that were really leading us higher while there was other laggards. Now, again, this ratio falls in, and I was expecting, given the late run that we saw in the reopening trade, for this to kind of cool off a little bit, Brett, as I thought that there was a little bit more breadth that was involved in the rally towards the back half of the year. Now, when we see this in here, the reason why this is a concern when you see this on the overly optimistic side is the idea that there's only a couple of names that really need to tilt over in order to pick up aggressive selling in the markets, that most of the money being concentrated in a certain area. Were you kind of surprised to see this one fall onto the radar for the extreme?
Not really, no. I mean, it just seems like everything is hitting highs.
Yeah, but in terms of but that also matches up against the low ratio too, in terms of people coming in, the low end of the fruit being raised up here. You don't see it as such?
Well, sure, okay, yeah. I mean, I understand where you're coming from. I don't think that I didn't look at it and say, wow, that's really surprising me. There are things that really surprise me right now. Like seeing the VIX where it is while the put call ratio is where it is. Like there's these fundamentally at odds ideas that are really difficult to process together. And I don't know if the breadth readings right now are shaking me quite as much. It's an interesting market, and from a bottom up perspective, it's kind of the most stock pickers market that we've had really in a decade and a half.
Yeah.
So I don't know how to take macro data on that kind of. Like, there's all these individual industry themes that are so kind of cohesive and internal to themselves and separate from the market that putting them all together in a tapestry. I don't know if I have an easy time processing what the read is based on the results of that.
All right. Now, when we try to match up the VIX versus the put call ratio, obviously the put call ratio has tended to run around. Most days it feels like we're seeing it start off around the 0.5 area and then slowly climbing higher. The VIX, for its part, has really just been floating above the 20. So, would you say that you would think that, given the put call ratio, we should be looking at a VIX that's closer down to that 13 level that we were seeing through? Yeah, I was going to say even as aggressively low as that. So, so you kind of view this VIX above 20 as being elevated. Do you think that there's any particular reason behind the VIX just really kind
I
of holding that 20 level despite that put call ratio? Is it that the
Yeah.
VIX data just doesn't really take into consideration as much as that retail buying?
No, I just think the VIX data is probably a more accurate presentation, which is why I've been gradually more bullish. Like I think that the put call data may not be um, as scary as the clothes it's wearing. And the VIX, where it is, may be a representation that there is a lot of catastrophe hedging that's sitting in the market.
All right. And then finally, we'll just touch upon this, the soft versus hard economic surprises, which basically, the read on this when it's overly extreme is the suggestion that the sentiment data is just simply not being backed up by the harder economic data. This was another one that I thought was a little surprising. I guess it's probably maybe more on a relative basis in terms of the hard data that I've been seeing outside of the jobs data has been pretty good. I thought certainly in line with most expectations. We're going to be coming up against some very easy comps here in a couple of months, so that's probably going to make things look a little bit better than they are. But I haven't found a complete runaway really on the sentiment data. You could
Hmm.
probably argue the NAHB housing market, but I mean, by most accounts, housing's in a bit of a golden age right now over the last year or so. Um, and then the ISM numbers, I thought, and the PMI data for manufacturing, I felt that they got reined in with some of their exuberance over the last 2 months here. So, you got any thoughts on the soft versus hard economic data that we've been seeing? And is there anything that you're looking for in the upcoming couple of weeks?
Yeah, so I would say, and we're going to get to some of this in a little bit, the fund manager expectations, the kind of glaring thing that I think is the center of the discussion to come, and was the center of the chart book I just put out, is you've got all-time record highs. Yeah, not to play spoilers here, but you've got all-time record highs in the Bank of America Fund Manager Survey for three things all at the same time, and that's earnings growth expectations, rising inflation expectations, and steepening yield curve expectations. Like this is people are expecting right now that we are, and maybe perfectly reasonably, that as we reopen, as the vaccine, as we move past the sort of into a more normalized operating environment, post-pandemic kind of operating environment, that you're going to see a normalization of a lot of different economic data points that's going to become hard data. So when you're looking at soft versus hard data, you're looking at expectations versus coming hard data points. And maybe a lot of people would see it as really reliable right now to expect that the hard data points are going to be playing catch up to the soft data points, right? Rather than that people are just people have absurd expectations for the future, that people have maybe greater faith that the hard economic data is going to start to become much better on a year-over-year basis as we get those comps going through for the rest of the year.
All right. So that'll wrap up the sentiment part of the show here. And I think the basic takeaway, I'll throw in my comments and then Brett follow up with anything you want to add on or expand upon. But really, it's very difficult to take a look at the option activity that we're watching and be able to take too much from it just because there's a new aspect to it with that increased retail participation. So what usually for us would have been a red flag in the current rally, we're probably able to see it sustain at these levels for a little bit longer than we're used to anticipating. I guess you could kind of run it along the same lines of we're in the mode of the Fed, Brett, where we're okay with inflation running above 2%. We're okay with this option activity continuing to push into overly optimistic territory. Now, it is going to lead towards probably some sharper corrections, similar to what we saw last week
Right.
when there was a little bit of forced selling. And but for the most part, we view that as maybe a buy the dip opportunity, barring any break of the patterns that we're seeing right now. Cash levels remain a bit of a question mark for us, as it certainly seems like a lot of cash has been put into work. But as we saw last year, that was the biggest surge in U.S. money supply in 150 years. I mean, we're going back to just after the Civil War when we were in the rebuilding of the South. What the last time we saw as much money pumped into the economy as we did in 2020, and that's definitely something that you got to take note of. But overall, the sentiment data is remaining extremely bullish, but it seems like it's sustainable at these levels. So, Brett, what would your overall take on that sentiment data be?
Yeah, I think that you've got a different game theory in play right now. It's just that doesn't really lend itself well to looking for optimistic extremes and fading them until we get to something that probably is quite a bit more egregious. And yeah, I think that the read through on some of the data points that we've been trusting is no longer something that you can really trust easily because there's been a foundational redefinition of what some of those data points mean. It doesn't mean that there's not good data points. You just kind of have to filter out some of that options data and look at the rest of it. And looking at the rest of it doesn't really look all that concerning.
All right. Now we'll break into the flow side of it, which is we're just kind of keeping an eye on where the money's going, what kind of influx we're seeing for stocks and bonds, and try to match it up with what we're just talking about with the sentiment data. So,
Before we do that, there's one thing that we didn't cover, which I threw at the top of our little outline. Just one thing I want to point out because it kind of grants some extra perspective. Everything we just said doesn't mean that there's not vulnerability. There's certainly vulnerability. We're somewhere in the process of building toward tremendous vulnerability, which will bear itself out on the flip side of this coin at some point. The shoe will drop at some point. This is not, infinitely onward and upward. And one of the markers along the way is, and I don't know if you saw this, that I added to our little note sheet, Gavin, is we've got the lowest level of short interest right now that we've seen basically in pretty much 2 decades, and it's something that we started to see in 97, 98, 99. It seems like these long-term structural bull markets gradually get to the point where basically everybody on the short side just starts to give up. And I think that we're going to talk about this more in a little bit, but the meaning of the whole GameStop experience that we just had over the last couple of weeks is really, a sort of a final nail in the coffin of the concept of shorting. And that's a marker on that path that says, you're getting closer and closer to where this is going to become something that's impossible to continue.
Brett, I did have a question for you on that in terms of when was this data posted and when did you see what the prior number was? Because I was curious if, a lot of shorts just kind of after last week's activity decided to just step to the sidelines. I mean, we've certainly seen. I'm looking at the chart there, and it looked like it was trending in this direction as it was for the last few years, and I did find that a little bit surprising, given some of the numbers that I've seen just when I'm going through and taking a look at be it the retail space that's been beat up, the large tech that's run away with valuation. You haven't really seen a lot of shorting in there, but definitely the brick and mortar space and just the short interest names that I've been following here. I was very surprised by that data, and I guess the question was, how much of it do you think has been chased out over the last couple of days too? Because we've seen Carson Block from Muddy Waters basically throw in the towel, or no, it was left from Citron who threw in the towel. I saw
unpublicly disclosing,
but yeah, publicly disclosing anyway. But we saw who is it? Hindenburg was out cautious earlier on a Chamath Palihapitiya SPAC, and they specifically said that they're not taking any shorts right now. They just want to note the structural differences between the current valuations and where they see it valued. So I'm just wondering, with the short interest being flown out, I recall back in 2006 we saw very similar activity with the shorts kind of being squeezed out in the markets. How do you see that function of the shorts being taken out of the markets impacting the overall mechanics?
Well, I'm just saying it's one of the markers along the way. So it's not a unique data point. That one is 1.6% of the float sold short is the median stock in the S&P. That's like a 17-year low. The 17-year low in the average stock in the S&P in terms of percentage sold short. There's something like an 8-year low in short interest ratio for the NYSE. There is for the D-trended NYSE, it's much further out. It's a multi-decade low. So it's across the board. There's no data point you can look at that won't show you something along the lines of basically there's no more short interest in the market. It's at really long periods. This is the lowest level it's been. And you're right. That's not something that just happened in the last couple of weeks. That's something that's been happening on a creeping level over the last couple of years. And over the course of this whole bull market, it's gradually gone down from where it was in 2009. And so it's just a function of the cycle and getting to the point where you go from what's the old line? Bull markets are born in pessimism, they grow up in skepticism, they mature in optimism, and they die in euphoria. And it's the life cycle of a bull market. And so I'm just talking about where your markers are along the path. Where are we right now? This is not a new bull market that started. Some people would say that last year was the bear market, and this is a brand new cycle, and it's fledgling, and it just is setting out on its 10-year road or whatever. This is not showing up in any reasonable look across data. This is where we are right now is a late cycle indication of, and short interest is a good way to look at that.
Right, and we'll take a look at a data point that suggests that managers are seeing that a little bit different. But yeah, I think it's very easy for you to kind of put out the idea that March didn't technically end the bull market. You can look at it as a non-GAAP bull market, right, where you eliminate the one-time items, and it's really just been a steady push higher in it, and that data point certainly.
And maybe you could say it's a new cycle, but there's a structural bull market that's aging.
Yeah. Yeah, no, but again, when we break into this fund manager survey here, there'll be some interesting data points on that. So let's take a look at that. So breaking into the data here, certainly things remain bullish. Brett had laid out some of the numbers, and we'll just recap them here in a second. We're looking at some of the extreme numbers here, and Brett talked about it. Expectations for global EPS growth is at 87%. That's an all-time high. Inflation expectations at 92%. For those of you who have been listening to Brett and I a couple of times, Brett, you remember this was at what, 8%? It might have been back just in I think it was like as late as November. It was at pretty low levels, and we talked about the expectations for this to rise, but it's really just skyrocketed it here. It makes you wonder if maybe people are getting a little bit over their skis in terms of expecting inflation. And we haven't really seen the reflation trade take off just yet, so perhaps it's just the sentiment data point that's outrun the flow that we've seen into that space.
It's a big question.
And then higher bond yields at 89%. I know we're talking about the spread that's going on here in the 2 and the 10-year, and that's certainly gotten a little bit more aggressive. I think we're at 3-year highs on the 2-10-year spread, if I'm not mistaken. Mm-hmm. So with any of those data points, is there anything that caught your attention in particular?
Well, I mean, the question is, are we at this, if you look back at some of these same data points and you look at the historical chart, usually when they get to levels near here, they start to turn out to be wrong. That doesn't mean that's going to happen now. We've got some very unique circumstances now. But usually when the fund manager survey shows everybody expecting higher bond yields, it's the time to start buying bonds. That's been, over the last 15 years or so, a pretty consistent buy signal for the bond market. So, the question is, right, are we going to see this big explosion in growth after we start to get this herd immunity process in place? And, it makes a lot of sense to me, but it makes a lot of sense to everybody all at the same time. And one would assume that there's a lot of bets all lined up on some things that are probably pretty leveraged when you start to get to an expectation like that. I'm not sure exactly the implementation because it's not showing up just directly in just a gigantic crash in the bond market or anything, but there's probably a lot of intricate ways in which bets on this same feeling are being structured right now in the market that could start to pop up, and we start to see some problems if it turns out to be a poor assumption.
That's interesting that you mentioned that on bonds, because one of the things that I wanted to ask you about that we could kind of build off that comment is you're a pretty big follower of reallocation and the impact it can have on the broader market theme. That's the idea that portfolio managers have to have a certain percentage of their portfolio based in stocks, bonds, and
Fixed
currencies
weighting.
are. Yeah, exactly. So, you hear a lot about the 60-20-20 portfolios or whatever it might be. When you're looking at that move in bonds or the move in yields that's signaling perhaps it's time to start buying bonds, and then the allocation, which I'm assuming is moving towards stocks a little bit above some of the levels that people would expect. Do you see this factoring into some upcoming gyrations, be it either quarter end of Q1 or any of the month ends?
Well, I guess I would see fixed weight charters changing. I
Okay.
mean that seems like the lot. If this is what the expectation is, and if it's not performatively opposed by reality, I would think that it starts manifesting itself in, you see like the sovereign wealth fund of whatever country changing their charter, and going from, reducing the percentage allocated to sovereign fixed income and increasing it to risk assets, and that's one of the other signposts along the path that we're on.
Do you view any level in the 10-year yield as one that is kind of a red flag for you on, hey, this might start attracting a lot of capital? Obviously, we're getting back towards the early January 2021 highs, which marked
Or
a
curve control.
10-month high curve control from the Fed.
Well, right.
So you expect the Fed to come out and say that they're going to be more interested in buying at the long end of the curve, and
Well, I
therefore
don't
you'll
know.
you'll
I
see
mean,
managers moving in a little bit more aggressively?
I, it.
Because there was something that we were
What do you think?
expecting from, well, we were expecting that from Powell 2, 3 calls ago, right? That was one of the things
Right,
that a
but
lot of people were expecting, and they never came out with that buying at the long end.
let's say we see the 10-year at 1.75 in a couple of weeks.
Yeah, then they would have to move on that, you would think, right? And
Right.
that would force bond buyers to jump back into the longer end of the curve.
Right.
Yeah,
And then you've got a whole shakeout.
yeah. So that'll be one of the interesting things. But so let me. But you would think that the shakeout probably comes before that, right? When people start telegraphing that move higher in the yields, because that's obviously, the big argument's been some of the attractiveness of stocks at these current valuation levels has been the low yields, right? And
Right.
the
It's
idea that
relative to
dividend
the
yields in
yields.
stocks are still way
Yes.
more attractive than treasuries. So
Right.
we probably would have seen that move before the Fed announces anything about buying at the long end of the curve, right?
Well, I mean, it's there's the tantrum is an expectation
Yeah.
phenomenon.
Yeah. Okay. And since you mentioned the tantrum, why don't we just take a look at the tail risks, because taper tantrum was something that popped onto radars here in the fund manager survey that we hadn't really seen too much mention of. Now, the number one tail risk was the vaccine rollout, right? That came in as 30% of the respondents had that as the biggest tail risk, and understandably so. Now, you're pretty savvy on this. Obviously, your wife's involved in the medical industry, and I know you've been on some calls with hospitals over the last year or two, and I've talked with them. How do you see the early parts of this vaccine rollout? Is there any red flags that you're looking for, or anything of major concern for you on that front?
So here's what I understand. I understand that it's going a lot better than people think, and increasingly so as far as availability of the vaccine.
Yeah.
So there's two things. One, there's several different dynamics. One is I think we're seeing material support for something that we talked about in December, which I called Brett's thesis. I don't know if you remember that. You remember Brett's thesis?
Obviously, titles
I'll
are
read
not our
that.
strong point here, but go on.
The creative title of Brett's thesis. Here
If
it is.
anybody's out there looking for a creative title job, let us know. But go on, Brett's thesis. I'm in.
Yeah, normally I take pride in my titling, but Brett's thesis, I want to be direct with that one. So my
Fair
thesis
enough.
was, after we started getting approvals of vaccines, my thesis was that we would start to see ahead of herd immunity, vaccine-based herd immunity, we start to see a sharp tapering of virus statistics across the board. And my theory was, and I think this is being supported at this point, as people know that they're getting closer and closer to getting a vaccine, they're more conscientious about preventing infection. And it's just when you're more likely to take risks when you think it's a never-ending negative situation, and when you think you're going to get a vaccine 2 weeks from now. Over that 2 weeks, you're probably not going to go in any really large gathering because people are still scared of this virus. So I think that we're seeing that. I think that's part of what we're seeing when we're seeing the rollover of data from 350,000 cases a day in the U.S. to like 105,000 or whatever it is now. We're still right in the middle of cold and flu season. So I think I don't think the vaccine can be credited with the change in virus statistics, and I don't think we've seen natural herd immunity. I think what we're seeing is behavioral change because people know that they're closer and closer to having a vaccine. So I think that's an important fact in and of itself. But what I know from who I've discussed things with is the vaccine rollout is going better than people popularly believe. But it's the biggest problem is that there's a lot of people who are nervous about taking the vaccine. So there's an availability issue, and that's doing better than people think, and there's an acceptability issue, which is doing slightly worse than people think. And I think a lot of this really is going to solve itself. I think that's going to be a deteriorating statistic because I think that, there's social groups, there's friends and family, and somebody gets a vaccine, and anybody who's nervous about it, who's in that kind of social circle, sees that person fine a month later, they're going to be more likely to just get the vaccine. So I think it's probably, and that's how it's going to be, how it's being handled by people who are kind of managing the process is that same assumption is built in, and I think that's probably a correct assumption for the vast majority. Now, there's going to be some small fraction of people exposed to like malicious propaganda and conspiracy theories from like anti-vaxxer groups, who may never come around. But for the vast majority of people who are concerned about it now, it's probably just that there's a dynamic that it's you're putting something in me. I'm not really sure about this, but then their friend got it, and they're just fine. And a month or two later, they're like much more amenable to taking the vaccine. So I think that's going to clean itself up, and I think that there's more top-down management of the process of the rollout. And I think that we've got 5 vaccines now, all of which 100% eliminate risk of death. That's pretty good.
That's pretty good for 9 months of activity, right?
It's really the important thing to focus on when people talk about efficacy. Like it's defined in different ways. When you're doing a pharmaceutical study, it's defined as like you can't show any symptoms. But the reality is, even when there's some symptomology, it's much reduced.
What was the incident with the people up in Norway? Wasn't there 26 people that died after being inoculated? Maybe it's fake news, and I just got caught up in the headline. I don't
know what the situation is, but I know that broadly speaking, from people that I interact with, there's a better rollout that people understand, and the most important feature of the efficacy is, what people are scared of is being on a ventilator in a hospital for a month or maybe dying, and. Yeah. We've got 5 different vaccines now that 100% prevent that, according to a growing data set, which is only going to get bigger and bigger. Yeah. So I think that the vaccine factor is probably going better than is being considered widely right now.
Okay, and we're keeping an eye on markets here. They're rolling off session highs, but nothing overly concerning. Keeping an eye out on that 10-year too as we talk here. Okay, so number 2 on the tail risk was taper tantrum coming in right behind vaccines at 29%. We were just talking to a certain degree about that. And, Powell and company have certainly been pretty steadfast in their direction here and saying all the right things about letting inflation run above 2%. So it's obvious that they are looking to be pretty careful. At some point, they are going to have to start hinting about rolling back. And I guess what it brings me to, Brett, is some of the recent commentary we've seen out of China in terms of them trying to be the quote-unquote adult in the room, if you will, and looking to rein in some of their easing policy here. Now, obviously, they've had a recent uptick in cases, so we'll see if they kind of adjust it. But they're kind of looked at as the FIFO of this entire COVID vaccine, right? First in, first out. And that's why, outside of being the second largest economy, why they've been people have been keeping a close eye on them. Uh, Christine Lagarde in the ECB meeting about 2, 3 weeks ago, she was kind of viewed as being slightly hawkish, and we know that she's been trying to pull some of the punch away from the markets in general as well. The COVID vaccine obviously disrupted any plan she had on that front. So I guess it's not completely out of the question, even though the Fed's tried to put forward that uber dovish look, that we could see a bit of a taper tantrum coming at some point. And I'd be curious as to your thoughts on, how do you see that in game theory playing out?
Well, I mean, obviously, it's going to happen at some point. It's going
Right.
to happen when it happens. And I think that they're going to be, and I also wonder about how much they want inflation. I mean, they really want inflation now. Like it's really good to get some inflation going at this given.
Well,
You know,
as they say about inflation, it's always good at the start, right?
yeah, well, I mean, initially, but then also when you've just created, trillions and trillions of dollars of theoretical future obligations.
Yeah. Yeah, I really wish Paul Volcker was still around. I'd be curious as to his thoughts on the current developments and stuff. But yeah, so taper tantrums, the other big tail risks that fund managers are worried about. Number three, I kind of felt played into the first two, Brett, and that's Wall Street bubble. And certainly on certain different valuation metrics, you could discuss about the bubble aspects that are there. But again, when you talk about the biggest money supply being pumped in 150 years, until they start draining that out, I have a tough time viewing Wall Street as being in a bubble with, being a risk when really you could probably combine two and three together for the tail risk. Would you agree with that?
Yeah, just to make sure that people are following, what this is these are the responses that people gave, who large fund managers who were surveyed by Bank of America and the monthly fund manager survey. The question basically is, what do you think are the biggest risks to the market? Probably, can be inferred as the biggest risks to the market uptrend. Right? Like, what do you think could derail the bull market? And so the answers that people gave, and the first one was, the vaccine rollout going wrong. The second one was basically expectations of the Fed pulling back. And the third one is that valuations are super overblown, basically. I think that the fact that that's number three is probably a little bit of a healthy sign for the market because, I mean, this is, just looking at it in a simple sense, normally, in 1999, Wall Street bubble wouldn't have been seen as a risk. That's why it was 1999. It was probably seen as a risk in 1996 and 1997 until everybody was, fully on board the deck of the party boat. But obviously we're coming into a situation where you have a lot of new shares being issued. You have a lot of offerings. You have a big expansion in IPOs and all these SPACs, and you've got a lot of new supply coming in. And at the same time, you have like record numbers of companies with negative earnings in the market. You can look at that as being a very simple way to look at things being, horrendously overvalued. And I guess the assumption is that a lot of that has to do with if this is a new cycle inside of a larger structural bull market, if this is a new cyclical bull inside of it, and we've got a new cyclical expansion going on, that you're going to see those mature into profitable companies as the reopening of the economy, and that the EPS side will catch up with the price of the stocks. But people can obviously simplistically construct a model that says that things are massively overvalued right now in a snapshot. And I think that that's probably responsible for that. But, we've talked about it too. Like, there's no short interest. There's a tremendous amount of new retail speculation coming in using highly leveraged derivative instruments on small accounts. There are features there that are bubblicious.
Yeah.
So it's not unreasonable to start to put that tag on it. Just the bubble can go on for another 2 years.
Yeah, yeah. No, I mean, 90. What was Greenspan's irrational exuberance was muttered in '96, and it wasn't until 2001, right, that we
Right?
saw it take hold. So, just because people are looking at bubbles doesn't mean that they're ready to be pricked yet. All right, let's take a quick look at the crowded trade, Brett, because there's two things in particular that I found interesting in this. Number one, long
Wait,
tech and
just to frame it. So this is the fund manager survey asks people, what do you think are the most crowded trades in the market right now? So this is the answer is not what is the most crowded, but what people think is the most crowded. Sorry, go ahead.
right, yeah. So, in the view of most of these fund managers, it's Bitcoin, which was notable because long tech had really been the primary answer for. I think it's going back about a year that's been the leading crowded trade, but we're seeing Bitcoin rise up to number one. It's the first time Bitcoin has jumped into that spot, I believe. We've
Really
we've obviously had a
interesting.
big run up on it until 30 to 38,000 here. So, you got any thoughts on Bitcoin and the trading activity in it? Obviously, we don't need to get into the weeds on whether we think it's a actual currency or not. I mean, you could always throw out if other countries are going to launch their own digital coins, how's that going to impact demand for Bitcoin? But you got any thoughts on the trading patterns of Bitcoin here, Brett?
I mean, I just think the fact normally I look at this question as a little bit of a contrarian indication. Like if whatever most people think is the most crowded thing, usually means whoever's giving that response probably doesn't own it. You know
Yeah.
what I mean? So there's a little bit of maybe Bitcoin can go higher because everybody thinks that it's the most crowded thing right now, and by the time it's really got a big problem in front of it is when everybody thinks it's great. So there's a little bit of that. You know, we've seen long tech go through that for the last 2 years, right? Everybody thought it was the most crowded, the long FANG stocks. Remember that? And it's been
Yeah.
like 3 straight years of people thinking it's the most crowded trade.
Yeah.
So, eventually people get on board the bus. Um, but yeah, I mean, other than that, it's sort of, it's an evolving market. It's got institutional traction now. It has, buy-in from JP Morgan and Elon Musk and PayPal and Square and all sorts of things. Like it's got a form of legitimacy that it hasn't had in the past, which allows for a lot more interesting things to go on, provided there's not some huge black swan new development that changes the game.
All right. And again, number two was long tech, in that
There you go.
it was the first time since October 2019 that long tech was not the most crowded FMS trade. Number three is interesting, though, Brett. Short
Mm,
dollar. And, that remains a pretty key read for it. And we've certainly seen perhaps some of those shorts covering here. And
yeah.
as the Dixie, which I got that chart up right now, has pushed above its 50-day moving average, getting back to 91.5 here. This marks the best level from it since just after Thanksgiving. There, when we're seeing it break down a little bit more aggressively. Do you think some of this has to do with questions around the size of the fiscal stimulus?
Do you mean the expectation
The
or the
expectation.
survey answer or the movement?
The positioning, for sure. I feel like the question is maybe a little dated in terms of the activity that we've seen, and I would be curious if this is going to show up in the February responses. I don't think that it's going to, but it certainly seems like people are getting a little bit more intrigued by the dollar, and I don't know if it's because of the idea that fiscal spend's not going to be as high as it is, and therefore, it'll be a little bit more manageable in terms of funding it, or is this, some people sneakily getting into a safe haven play and buying the greenback? We're obviously coming up, as you can see on the daily chart, against that downward trendline resistance, so it's going to make for a big test in one of the key areas in the markets over the next couple of weeks. And you could also argue that this move has also come with the rise in rates too, which kind of go
Right.
hand in hand. But you got any
Well, yeah.
thoughts on the dollar positioning?
I think it got really. We have data to suggest that by the time we were coming into the Georgia Senate election, that there was a lot of consensus expectations of the dollar going down. You and I have been bearish on the dollar for 6 months or so coming into that, and we reached a point where, to me, the Georgia Senate election was an inflection, and that turns out to be the absolute turning point for the dollar. And I think that yeah, it's highly tied into what fiscal stimulus situation can do for bond yield. We saw the yields completely change in character off that Georgia election. And now you've got this kind of relative value argument for capital flowing into the United States because you can just higher return on fixed income for a risk-free instrument. And at the same time, like coming out of what we're dealing with, and this is what I put in my chart book, with the economic landscape, the way that it's structured right now in the United States, stimulus can be really economically productive. If you pour money into certain things, there's a huge GDP output positive, right? Because there's so many things that are still not really functioning, even though we see all the speculation markets. There's a lot of pockets in our economy that just aren't even functioning, and you pour capital in them, you give them a little bit of a base, and they start functioning a lot better. And we have seen already kind of a big transfer of assets on the stronger in the balance sheet. We had a sort of creative destruction period over the last year that's powerful looking forward, even if it's not necessarily something you consider to be just or what people wanted to happen in any way. But if you pour money into that, so the stimulus we put in, so I think larger fiscal stimulus, it drives rates higher, but it also actually increases GDP. And both of those reasons are going to be a relative value argument for the United States if we can do it. And you put the biggest balance sheet in the world into active use. And I think the other thing is you have risks. When you have, I'm a big believer that we've been in a sort of hyper-partisan death spiral politically in this country, and I think that has economic limitations, and it increases risks, especially when you're going through a crisis. There may be some very common sense steps that need to happen in response to things that emerge over the next month or two. Something could go terribly wrong, and are we able to respond to it? And I think that there's a paralysis that comes from, the type of massively polarized political landscape that we have that's made it right through to Washington, D.C. on a lot of levels. And I think just shifting, even if there's, a lot of filibuster prevention from a lot of things, and there's still obviously a ton of partisan strife. I just think that in a very basic sense, having majority control in either party, but just in one party, creates a common sense response possibility that may not have been the case without that shift in the Georgia Senate election. So I just think probably that de-risked against new black swans that could happen, just having the ability to act. And so I think that probably, you've got this relative value argument and that, and I think the consensus is shifting, and I think rates are a big part of it, but the consensus is shifting. We've seen Citigroup come out, Bank of America come out, recognizing this. Citigroup's still bearish on the dollar, but shifted to near-term bullish. Bank of America shifting around to bullish. There's a number of different houses that have come out that were really bearish as of like 4 or 5 weeks ago. So I think that that's a dramatic shift in the sort of really deep level financial markets landscape, the shift in expectations around the dollar over the last several weeks.
All right. And then we're just going to cherry pick a couple of points here. Then we'll have a quick discussion on the Robinhood situation. And we're not going to really get into too much of did the big guy screw the little guy or anything along those lines, but really just looking at it from the aspect of how much can these retail traders really disrupt the hedge funds and cause a forced selling incident like we saw last week. So Brett, taking a look here at some of the numbers we just talked about, the U.S. dollar, again, from the fund manager surveys, with regards to the Biden focus, the number one expectation was for them to focus on healthcare, number two, infrastructure, and then number three, income inequality. So pretty much all in line with the expectations there in the markets. With regards to the U.S. indebtedness solution, higher taxation was definitely the number one thing that people were looking at, with number two, inflation. And number three, modern monetary theory. So, basically the idea that they're going to monetize the debt away and, just print so much money that it's easy for them to cover the debt.
And which of those three is what you just said?
Right? I mean, that's basically
what's going to be easiest for people to do.
Well, number three is definitely the easiest.
But number two and number three are way easier.
Well, I think number three is the easiest. Number one and number two is the most sensible.
No, but I just mean, like, if you think of a populist political atmosphere, like, if you could get inflation, now inflation, maybe you can't get it to happen, But if you could inflate some of this away and monetize some of it without having to go out and say, here, we're raising your taxes.
Yeah.
Obviously you're going to do that. 2 and 3 are what people are going to try to do. I think this is a given.
Right.
That's why I was not saying, with the federal, with everything coordinated around, like they want inflation. They want inflation, and they want to find a backdoor way to monetize things. That's my view.
Yeah.
That's why I'm long gold. But it just, that's been the structural long gold bull market argument.
Speaking of gold, Brett, any thoughts on today's action? That had a little bit of a breakdown here down in the 168 area coming to those December lows. I'm tempted to buy more, to be honest. But that's an ugly looking chart, so I'm not in a rush to do it here.
It's a tough range. The bottom is going to drop out when that range broke, and the question is, do we see the bid come in on a larger time frame?
Yeah. So that'll be something that we want to continue to keep an eye out on it. But it is funny seeing these inflation expectations skyrocketing here, and then just gold selling off in reaction. Maybe it's just all Bitcoin now and gold's a done deal, but I think it's too early to put the nail in that coffin. Okay, next up, I thought this was interesting. What would you like to see companies do with cash flow? And we talked about this last time, and this is where you could get real escape velocity, from my opinion, in 2021 going into the back half of the year. And that is, we have seen a growing expectation from fund manager surveys that would like to see companies invest back into the company and increase capital spending in order to increase capacity utilization, basically making more product. And one of the things that we talked about going into this earnings season was keeping a close eye on inventory commentary from companies. And so far, pretty much across the board, any of the ones that I've been listening to have been talking about their low inventory levels, which at some point is going to need to be replaced. And that's going to really pick up in a strong demand focus that I think is going to play out towards the middle of the year. So you got any thoughts on that theory, Brett?
So if you're saying, do you heal the balance sheet or increase CapEx, right?
Yeah, so in general, the majority of the answers have been for the last 9 months. Fund managers wanted to see them lower debt, and we're slowly seeing them move away from that lowering debt and increasing capital spending in an idea that they're going to have to play some catch up with the economy when it reopens.
Right. I'm just so framing it for people. So the large investors in companies, if you get a bunch of cash, do you want them to use it to just heal the balance sheet, or do you want them to invest it? Like, in other words, what is the productivity of capital? And it goes right in line with interest rates. Like, when you've got a situation where interest rates are going down and down and down, and there's a lot of competition to lend, the return on expected investment, the expected return on investment for any new dollar, when you have a declining interest rate environment, is lower, lower, and lower, because everybody's competing to be a lender. Everybody says that the future value of this money is greater than the present value of this money. It's the same basic equation. So you've got an expansion on a cyclical level. Right now, people are acting as, for the first time in quite some time, and this goes along with the other statement, the all-time high, record highs in survey respondents saying it's going to be higher profits, higher interest rates, and higher inflation. It's the same thing. Everybody's expecting the productivity on current capital to be really high and to be worse in the future. You want to invest it now. You want to buy stuff. You want to increase. You want to invest. You want to expand right now, because that is going to be how you generate a return. And in the environment we've seen for the better part of the last decade, we've consistently seen people competing to be a lender, because there's going to be some time in the future where that dollar is going to be more productive in terms of its return. So you want to basically park it and use it later. And right now we're seeing this thing that looks like an early cycle pop in terms of the psychological underpinnings of everything that's happening. And it shows up in interest rates, it shows up in expectations for inflation, it shows up in expectations for profits, and it shows up in what large investing companies want that company to do with their next marginal dollar. And that's really important. It's one of the reasons why we're seeing such an unstoppable bid. And rising commodity prices and dropping bond prices, rising interest rates, the whole thing has this kind of growthy energy to it.
All right. And then the last piece from the fund managers survey that I thought was interesting, fund managers were asked, what level of risk do you think you're currently taking in your investments? It was a record high 19% thought that they were currently taking higher risks than normal. You think this has
same thing that I just talked about?
Just all the liquidity being pumped in that.
No, but this is the time when you invest money, it's going to have a higher return.
Yeah.
It's the expectation of a higher ROI on everything. And so you're going to take more risk in a situation like that.
Right, and that's obviously playing out here with the Fund Manager Survey. And we talked about the risk and the derivatives, so it's definitely a market that is certainly leaning in the direction that we could go higher. And again, looking at the sentiment data and the flow data, all signs of this would point towards the potential for a rollover. But really, the difference maker is the amount of liquidity in there, and the idea that this could go for a little bit longer, given some of the conditions that are in place.
And let me just insert one more comment. Everything I just said, these expectations, you know, they could all turn out to be wrong.
Yeah.
You have to also throw in that factor. Just because everybody believes something doesn't mean that it will be right, but it's important to understand what everybody seems to be believing in a consensus kind of way. Again, we're talking about record high survey results and a lot of different data points that all point to big assumptions. Why the chart book I put out a couple days ago was titled "Great Expectations."
Yeah. Yeah, no, very, very apropos for the times, that's for sure. So, all right, Brett, I'll tell you what, we're running at about an hour and 10 minutes here. So what we're going to do is just turn the last part of this conversation to the Robinhood discussions here, because I think it is important for us just to touch upon it and our general thoughts. And again, not really looking to get into the who screwed who here and or anything, but it's really just understanding how it could impact your trading is what I want to focus on. And I think for me, Brett, it was definitely a savvy attack by the retail crowd going after that short interest squeeze. We've seen short crushers in the past have success there. And really, I think more than anything, it kind of goes to the analogy that you always like to use, where you're trying to push a ball underwater and there's just simply too much liquidity there. I think that makes for a good analogy for what was going on, particularly in GameStop, where there's just no direction for it to go but popping out of the pool because of the amount of short interest that was held. I think it was something like 150% of the float was short. And then when you got people buying on top of it, you see the moves that happened. Now, we've also seen that move die down. I don't think the vigor of too many of the retail people or the populace that think that they're taking down Wall Street by jumping into these trades has died down. But you're not seeing the same impact. I think that was perhaps most significant yesterday when we saw GameStop move from 80 to 130 and Mark Cuban coming out with his tweets telling everybody to hold, which I thought was just a horrible thing for him to do personally. I mean, he should know better than that to cause people all that money.
Yeah, this has been just devastating for people.
Yeah, and now where did we say? I saw it last time I saw it was like at 68 or something. I had a friend of mine
54.
54. And this is the real impact. So from my aspect of it, Brett, I really thought that a lot of that squeeze that we're seeing was hedge fund on hedge fund crimes, where people knew that some hedge funds were in trouble. And you don't see a retail crowd buying a 10,000 lot, which you saw a few orders.
You don't.
Like that
not at $300 a share. It's just not happening.
It's just not happening from the retail crowd.
Ridiculous.
Your one buddy that was talking about YOLO and buying one share to drive the hedge funds out of business. You're not going to do it. It certainly caused some.
It's a nice story.
It was a nice story, but I'd love to see this crowd involved. It creates volatility, and I don't think that it's the quote unquote dumb money, but I think that they failed to understand some of the mechanics behind it. And one of the key things I thought was the vitriol that's being thrown at Robinhood for shutting down the trades. I don't think people really understood the backdrop there and the need for Robinhood to keep collateral in their bank account in order to cover the trades, because there's a 2-day grace period between transactions going through that you are more or less buying on credit, and you have a credit line extended with for Robinhood in particular. It was the DTCC, which is the clearinghouse that they work through. And once that credit limit is thrown out, then you simply can't expand on it anymore, and you have to shut down the trades because you can't afford, you have no place to put those trade orders in. I think the idea that trading is free was a misnomer. I think perhaps they did a poor idea of showing that aspect to their users when they were coming in. And again, it just speaks to you have to be savvy of what you're doing with your money. The idea that you think you could drive hedge funds out and destroy the markets by buying a few shares of GameStop was a gross misnomer. And I'd be curious as to your thoughts on some of the things I just touched upon there, Brett.
Maybe there was a powder keg and there was a match put to it, and probably, there was a lot of responsible parties involved, and probably a lot of the capital driving that whole process was not on Wall Street bets, but they were part of it, and it was a, as I call it, a darling saga for the financial media, because it's perfect for the moment that we have culturally to kind of focus on this sort of, the masses versus the elites kind of situation. But the reality of the situation is probably it was probably devastating for 90% of the people who got involved, because probably a lot of them got involved at significantly above $55, and it's just too bad. But I think that it introduces the existence of a regulatory problem, which is going to be impossible to solve, but probably not even necessary to solve. Just one that's interesting to contemplate. And then also probably it's a scar, and it's a trauma for funds that had, and it's another signpost along the way as we mature in this, from optimism to euphoria in our adventure in this cycle. That this is another signpost. As we talked about it earlier, there's barely any shorts left in the market at all. And the way that I look at it is, we were rooting out the last places where shorts are hanging out, and this is just the interesting way that story unfolded. But 150% of the float, like, what are you doing? And that risk was maybe something you could take for these marginal little moves in the past, but we're at a different phase of the cycle now, and that's no longer going to be unrewarded by pain. And obviously we've seen the results, and the funds that would ever have the business model of being willing to do that sort of thing, they aren't going to be willing to do it anymore. I think that's where we passed that step in the maturation of this bull market.
Yeah, and I think the other important item on this bull market too is you saw a lot of people talking about long-term capital management. This was a firm back in 1998 that collapsed, a hedge fund. And I think that it's really important to put out some of the differences between the two, because once that selling started, you had people talking about a hedge fund collapse. The monies that we're talking about are nowhere near in line. This isn't an apples to apples. Yeah. But even that, so long-term capital management in 1998 had 126 billion in assets under management. Think of that. That's 1998. That was 23 years ago. So
that'd be like a trillion now.
Yeah, when 126 billion meant something.
They were the biggest player in most every market in the world.
Right, and what set them off was they were able to get through the 1997 Asian currency crisis, and basically their model was to hedge against volatility in the currency markets. Now that got disrupted in August of '98 when Russia declared that it was devaluing its currency, and that really set off a movement and reaction in currencies that they simply were not prepared for on the volatility side. I think the long-term bonds in the U.S. dropped one whole percentage point because everybody was piling into the dollar as a safe haven, and that created further volatility within the currency markets. So,
and everybody knew where they were.
Yeah, and everybody knew where
that was the big thing. Everybody knew where LTC. Once you knew what position they were in, you back away from it and you let them blow up, and you take the other side of it and you hammer it, because just like once these guys got blood in the water in that Reddit room and they started to realize, Melvin needs to raise $3 billion. They're on the ropes. Let's hammer it, because eventually, they've got to take the other side of that. What did they cover at 500? Eventually you have to puke it out. And if everybody knows, if you're the biggest player in the market and everybody knows where you are and what you've got, you're dead. And when LTCM was the biggest player in every market. And the word got around pretty soon. And there's a great book on this. It's called When Genius Failed. And if
Yeah.
you're looking for a really good finance book, it's really spectacular. Really gets behind the scenes by Roger Lowenstein. When
Yeah.
Genius Failed. But
Fantastic read.
it just really shows, like, once word got around where LTCM was, it was like blood in the water, and everybody got a piece of it because you knew the orders from the side of it. If you push them a little further, they're going to get to the point where they can't do it, and they've got to do something at really advantageous prices. It's like being cornered. It's like in the old days, 150 years ago, when people used to get cornered. Nobody's going to buy it at $10,000 a share unless you absolutely have to, because you can force to liquidate. So if you can force somebody to an absurd price and they're forced to take the opposite side of the trade of what they're holding, you make a fortune on it being the other party in that equation. And LTCM's blow up, it was blood and water. People were a little worried that, and certainly that happened to some extent with Melvin. It just wasn't systemically important.
Right. And was it Maple Lane, I think, was another
And Maple
one.
Lane, and probably somebody else.
Yeah, probably a few others. But and we saw the disruption, and we saw how quick buyers stepped in to defend it. So don't be looking for hedge funds blowing up like this by the retail crowd. It's a completely different animal. We're talking about completely different sizes here. So, all right, we're about 10 minutes away from the close here. We got some earnings coming up, so we're going to wrap up this discussion here. Hopefully everybody found it of great interest. The bottom line for me, Brett, is that we're seeing an extreme in sentiment that's probably being offset a little bit by some of the changing dynamics that we talked about in terms of retail participation, the increased use of derivatives that's given that retail participation an outsized impact on the moves. We're also seeing certainly signs that hedge funds and fund managers are fully involved in this market, but we continue to see money being pumped in, some high upside with the potential for fiscal stimulus and further monetary stimulus that suggests that while we are certainly seeing signs of a bubble, there's still upside before we completely hit that euphoria where you're shaking your head and just throwing the towel against shorting it. But again, the short interest numbers that we pointed out suggested that we're getting closer on that, but this can run for a while longer. So while we're definitely cautious and highlighting these moves, and we'll continue to watch them closely, it's tough to see anything that's really offsetting the trends at the moment.
Yeah, I don't see a major hurdle right now, and we can keep expanding the pie for a bit.
All right. Anything else that you want to add in here, Brett, before we close off?
No, I think that was a very comprehensive summary.
All right. Well, thanks everybody for listening. We're going to be posting this on the site this afternoon. If anybody missed it, would like to take another look back. But we tried doing this every 2 weeks. We got delayed a little bit this time around just because we wanted to catch up with the open access crowd to give them a taste of this show. And I know we're going to be talking again on Tuesday for a trader strategy meeting, which Brett and I will probably recap some of our thoughts in that meeting too. But Brett, always a pleasure having you on. Anytime you want to jump on audio, you got the open invite out there.
Okay, thanks, Jeff.
All right, everybody take care. I'll jump back on here in 2 minutes and do a quick run through of some of the earnings as well. So
Okay.
talk to you later, Brett. You take care of yourself.
You got to take care.